Well, hey there. It's Terry Sawchuk from Sawchuk Wealth. Today is Thursday, so we're going to do a 3-minute Thursday. It's also Halloween, and as it turns out, the market was kind of spooky today, which got me to thinking about another spooky time. And that was obviously, well, maybe not obviously, but to me it was obvious, the 2008 and 2009 market crash. Now, why do I bring this up? Well, the reason that I want to talk about it is that let me start by looking at this trend line here. Okay, so you can see that this is the S&P 500, and this is actually a monthly time period. So each candle on this chart represents 1 month's worth of time. Okay, now what you can see is that we are touching the upper part of the channel. Okay, and that tends to indicate when the market is kind of getting overbought and is due for a bit of a correction. And we really haven't, I mean, 2022 was a rough year, but we bounced back pretty quickly. And that was mostly a function of interest rates. When you go back and you look at the 08-09 global financial crisis, that was naturally more systemic. And what I want to call your attention to, because I think people have just forgotten, if you go back to kind of the peak in September of 2007, that's where the market kind of had its highest point before the dip. Then it crashed, and then it didn't recover fully until about April of 2013. So we're talking about 6 years where you could have been invested in the stock market and not only just got back to break even, but didn't make any money in the stock market for literally 6 years. And so that's a little bit concerning, because when I look at the upper end of this chart, we touched it right at the end of 2021, and you know what happened in 2022. So here we are, effectively 3 years later, and we're touching the upper channel, and I've got a red triangle here, down here. This is typically a sign that we're due for a reversal. And this is what I'd call a bearish reversal, in that it's at the top of the chart, and it means we're more likely to reverse down. It's not imminent. Okay, I don't mean that this is going to happen next week or even next month, but I do think that within the next several months, it's quite possible that we could see this thing start to move back down. Okay, and if you just get to the previous high, we're talking about 1,000 points, and if you get back to the lower end of the channel, now we're talking about 1,800 points. And it's possible to break through the lower end of the channel. Not that I think that's going to happen necessarily. During COVID it did, but that was very brief. But I think the more salient point here is that it sometimes throughout history takes a long time for the market to recover. It's actually a more recent phenomenon that the market recovers so quickly like we did during COVID and frankly after 2022 to all-time highs. So I think the reason that's important to think about this is because you need to have risk management in place. People have gotten too complacent. The biggest complaint that I hear is that we're not bullish enough, right? That we're not making enough money potentially, and I don't mean we as a firm, but just in general, when people talk about the stock market, this is kind of what they're saying. And they've just gotten to the point where they don't really worry too much about protecting the downside. They're just more interested in making money. And, when we start to get to that level, it's usually a good sign that the market needs to correct and inflict some pain. So hope that doesn't happen, but it probably will. If you're a Sawchuk Wealth client, don't worry, you're in good hands. If you're not a Sawchuk Wealth client, you probably should be. So with that, I'm going to wrap up this week's 3-minute Thursday by saying Happy Halloween, and I will see you next week. Oh, and don't forget, next Tuesday is Election Day. Most of you probably have already done it, but if you haven't done it, get out and vote. We'll see you next Thursday.